Welcome to the deep dive. Today we're tackling something that sounds simple on the surface but gets really complex when you dig in. The actual daily cost of a government shutdown.
Right. You hear these numbers thrown around in the news, often a pretty clean figure, maybe $300 million a day.
Exactly.
Yeah.
And it sounds like a lot, sure, but it always feels a bit fuzzy. Like, where does that number even come from?
It does. And that $300 million figure, well, it's often used because it's conservative, it's kind of easy to track, mostly linked to federal payroll that usually gets paid back anyway.
Okay.
But that's not really the whole story, is it? Our goal here is to get past that surface number. We want to understand the real economic hit per day, especially the stuff that doesn't get fixed later, those hidden, non-recoverable losses. Back pay doesn't cover everything.
Okay, so let's start with the baseline people usually hear. Looking at past analyses, like from the CBO, the Congressional Budget Office, and benchmarks from places like S&P Global, the usual starting range seems to be about what, $300 million up to maybe $1.0 billion per day?
That's the common consensus range, yeah.
Hmm.
Our theoretical starting point. But almost immediately, you have to adjust that upwards.
Why is that?
Because when you factor in things often left out, like how businesses react, the penalties paid because the government isn't reliable anymore. Our adjusted working range for a typical shutdown day actually looks more like $350 million to about $1.05 billion per day.
Okay, so already a bit higher. But then there was this other idea in the analysis, the peak day tail risk. What's that about?
Yes. That's when everything goes wrong at once. Think about a shutdown hitting during, say, the absolute busiest travel week of the year, or right when tax season is peaking.
Maximum chaos.
Exactly. In those worst-case scenarios, the analysis suggests the economic damage could spike dramatically, hitting $1.2 billion, maybe even $1.3 billion in a single day.
Wow, $1.3 billion a day, that's staggering.
It is. And that tail risk, that's the cost of things really going off the rails. We need to grasp that. And just to make that huge number feel a bit more real, we can translate it. Think about it per household. There are about 132.2 million households in the U.S.
Right, so if you take that peak day, that $1.3 billion, what does that work out to per family, roughly?
It comes out to almost $9.83 per household per day.
Nearly $10 a day per household just evaporated from the economy on those really bad days?
Precisely. And look, this isn't a tax bill showing up in your mailbox. It's a way to understand the scale. That $9.83 represents the drag, the cost of that political risk spread across everyone.
Sure.
It shows how tangible this actually is.
Okay, so the real range is quite a bit higher than that initial $300 million anchor we often hear. Let's dig into why. What's the fundamental reason most stats seem to get this wrong?
Well, it really boils down to one key mistake in how it's often reported. Mixing up budget losses with economic value losses. They're not the same thing at all.
How so?
Most reports focus on the budget. Will federal workers get back pay? If Congress approves it later, the budget numbers eventually look okay, right? But that's looking through the wrong end of the telescope.
Right, because we're not just talking about making paychecks whole again. Congress can fix that part. We're talking about the actual services, the activity that just didn't happen that day, and it's gone forever.
Exactly. That's the crucial point. If a national park is closed or a business can't get a crucial permit processed, that economic value is lost. You can't get it back. Back pay fixes a line item in the budget, sure, but it doesn't magically restore the park visit or the business deal that died on the vine.
That CBO analysis of the big 2019 partial shutdown really highlights this, doesn't it?
It really does. That was a 35-day lapse. The CBO figured it shaved $11 billion off the total national output.
Okay, $11 billion total hit.
But here's the critical part.
Okay.
They estimated $3 billion of that was permanently lost, just gone, vanished from the economy.
$3 billion, that just poof. That permanence is kind of scary. And you mentioned things like missed park visits, but also federal contractors sitting idle. That seems huge.
Absolutely huge, and often overlooked. That permanence forces our working range higher. The analysis points to about 5 key factors that those standard conservative estimates usually underweight. These are why the true cost is so much higher.
Okay, let's break those down. Factor 1 you mentioned, reliability penalties. What does that mean?
This is really interesting. It's basically a direct cost slapped onto private companies because the government dropped the ball.
Yeah.
If government functions stop, say, clearances get delayed, inspections don't happen, private firms like airlines or big defense contractors might actually have to pay penalties, liquidated damages, late fees in their own contracts with their customers.
Wait, so because the government side isn't working, a private company ends up paying a fine?
That's it, exactly. And that cost, It doesn't show up anywhere on a federal budget report, but it's real money lost in the private sector. Even if you just put a tiny, like 1% surcharge for unreliability on maybe $1 billion of affected daily activity, that's an extra $10 million in costs right there per day.
Okay, that makes sense. Factor 2, averages hide peaks. This connects back to that $1.3 billion tail risk number, right?
Totally. Averages smooth things out, but reality isn't smooth, especially under stress. If a shutdown hits during peak holiday travel, when TSA is trying to screen maybe 3 million people a day,
Yeah, chaos.
the delays, the congestion, the lost time, the missed connections, the economic damage is way, way worse than if it happened on some random quiet Tuesday in February. The system breaks down right when it's needed most.
Got it. Factor 3 is behavioral deferrals. This sounds a bit more subtle.
It is, but the impact is massive. It's about confidence, really. Think about households waiting for big chunks of money, like their tax refunds. If there's uncertainty, if the IRS processing slows down, people hesitate.
They put off big purchases.
Exactly. Buying that new car, the fridge, the washing machine, they wait. So if maybe $3 billion in expected tax refunds gets delayed by just one day because the IRS is short-staffed or partially closed, the drag on consumer spending that day could be somewhere between $45 million and $90 million.
Whoa, hold on. That $45 to $90 million isn't like interest costs. It's the cost of people literally just not buying stuff because they're waiting for their refund money.
Precisely. It puts a chill in the consumer economy.
Yeah.
That spending might happen later, maybe, but for that day, it's gone. It's an immediate hit to GDP growth.
Okay. Factor 4, you mentioned this earlier, and it sounds like a big one, contractor non-recoverability.
This is where that word irrecoverable really bites. Federal employees, they usually get back pay eventually. But think about all the private contractors who rely on government projects.
Yeah.
We're talking maybe 150,000 people.
Yeah.
They typically cannot bill the government for the time they spend sitting idle because their project is on hold due to a shutdown. Their hours are just lost.
The analysis estimates this could be around $60 million per day in lost wages and company profits, just extinguished, gone forever.
Wow, okay. And the final one, factor 5, spread channel scales. This sounds like it relates to the national debt.
Absolutely. This is about the financial markets. When we see political brinkmanship, like fights over shutdowns or the debt ceiling, the market reacts. It gets nervous.
How does that show up?
Investors demand a slightly higher interest rate, a spread to hold U.S. government debt. They want a bit more return for the perceived extra risk. And given the sheer size of the U.S. national debt, even a tiny increase in that interest rate has enormous daily cost implications.
Okay, let's follow that money trail then. We know why the standard numbers are too low. Now, looking at that higher range, that $350 million to maybe $1.05 billion a day, where are the biggest impacts actually felt? Let's start with travel and tourism leakage. Yeah, this is a classic example of what economists call non-substitution loss. If you planned a family trip this weekend to, say, Yellowstone, and it's closed because of a shutdown.
You probably don't just reschedule the exact same trip for next weekend.
Right. The hotels, the gas station nearby, the local restaurants, they lose that business. It's gone. The U.S. Travel Association, back during a previous shutdown, estimated these kinds of travel-related losses were maybe $152 million per day.
And specifically for the small towns right outside national parks, the analysis mentions something like $31 million a day in lost visitor spending. That's devastating for those local economies.
Absolutely devastating. And then layer on top of that the air travel mess. When the FAA and TSA are short-staffed because of furloughs, delays just explode.
Right.
The Department of Transportation actually puts a dollar value on people's time. For personal travel, it's around $25 an hour. So think about 2.5 million people flying on a given day. If they each faced just an extra 10-minute delay because of shutdown-related staffing issues.
Okay, 10 minutes times 2.5 million people.
It works out to about $10.4 million in lost time value alone. That's productivity gone, connections missed. It's a real cost.
And it's not theoretical, is it? I remember back in January 2019, there was that ground stop at LaGuardia Airport in New York that was directly linked to air traffic controller staffing shortages during that partial shutdown.
Exactly. It happens, and it happens fast. What's also wild is that some costs pop up even before a formal shutdown starts. Just the government doing contingency planning, running drills, that costs money.
Preparing for the worst.
Right. But the really big kind of invisible ongoing cost driver is that potential shift in interest rates we talked about, that debt spread impact.
Okay, let's put some numbers on that again. The public debt is massive, what, $37.4 trillion? So if political uncertainty makes borrowing just slightly more expensive.
The numbers become staggering very quickly. A tiny, tiny increase in the interest rate demanded by markets, just 1 basis point, that's 0.01%, on a debt that size adds roughly $10.2 million per day to the government's interest costs.
$10 million a day for just 0.01% increase.
Per day. And that cost keeps adding up every single day that interest is paid or debt rolls over.
Okay, but wait. If Congress fixes the shutdown after, say, a week, does that extra $10 million daily cost just vanish? Does the market calm down immediately? Or does that higher interest rate kind of stick around?
That's the multi-billion-dollar question, isn't it? Market confidence might rebound pretty quickly after things are resolved. But any debt that was issued or refinanced during that period of uncertainty, it's now locked in at that higher interest rate for potentially months or years, depending on the bond's term.
So it leaves a lasting financial scar.
It can. And if the market starts to see this political dysfunction as a recurring problem, as systemic risk, then that risk premium, that spread, might not completely disappear even after the immediate crisis passes. If uncertainty pushes that spread up by, say, 5 basis points, now we're talking about an extra $51.2 million per day in interest costs until confidence is fully restored. And this really brings us to how these costs build on each other. The analysis makes it really clear. The damage from a shutdown isn't linear. It gets worse faster the longer it goes on.
It compounds.
Exactly. Because that share of the damage that is truly irrecoverable, the lost contractor work, the stalled research grants, the vanished tourism dollars, that share keeps growing every single day, the shutdown continues.
The analysis laid out a few scenarios based on duration and scope, right? Like different damage zones.
Yes, it did. Think of it in stages. First, you have a short jolt, maybe 3 to 5 days, limited scope. The daily cost is still significant, maybe $250 million to $450 million a day. The main problems are immediate things, like airport lines because of TSA staffing, park closures. The permanent damage share is relatively low to medium.
Okay, manageable, but still costly. What's next?
Then you get into the grinding pause. This is where it lasts longer, maybe 2 or 3 weeks, and it affects more agencies. The daily cost range jumps up to $350 million to $700 million.
And what kind of damage are we seeing then?
Now you're hitting core government functions. Big delays in loan approvals, for instance. Think about the Small Business Administration, the SBA or USDA loans for farmers. Businesses, depending on that capital flow, get squeezed hard.
And research must get hit badly, too.
Hugely. This impacts future innovation and growth. During that 2018-2019 shutdown, something like 111 grant review panels at the National Science Foundation, the NSF, were just canceled.
So scientists couldn't get funding reviewed.
Right. That means vital research gets delayed, projects stall. That lost time in scientific progress is incredibly hard, maybe impossible to ever fully make up. The irrecoverable share of the damage is definitely medium by this stage.
And the worst case scenario.
That's the structural harm zone, 30 days or more, broad scope across the government. Here, the daily cost hits $600 million to $1.0 billion, maybe even more on some days, and the share of permanent, irrecoverable damage is high.
What drives costs that high for that long?
Now you're seeing long-term effects. Sustained higher interest rates on the debt because markets have lost confidence. Federal employees starting to leave real attrition because they want job stability, which hurts government capacity long-term. Delays to major critical defense programs. The damage becomes deeply embedded.
And even when it finally ends, there's still a cost, right? The restart friction.
Absolutely.
Right.
You can't just flip a switch and everything's back to normal. Agencies face enormous backlogs of work. Permits, applications, inspections. Everything piled up. Clearing that takes massive amounts of overtime, extra resources. There's compliance work that needs redoing. This restart phase can cost large agencies tens of millions of dollars after the shutdown is officially over. The meter really does keep running.
So wrapping up this deep dive then, it seems clear that the real cost of a government shutdown goes way beyond that simple, often quoted $300 million figure. We really need to be thinking in that higher adjusted range, $350 million to $1.05 billion per day, potentially even more on those peak stress days.
I think that's the main takeaway. The biggest drivers aren't really the federal paychecks, because that money usually comes back through back pay. The real, lasting damage comes from those non-substitution losses.
Right. The tourism that just evaporates.
The contractor wages that vanish forever. The business loans that don't get approved in time. The research that stalls. And, maybe most importantly, that hidden cost multiplier from even small movements in interest rates on our national debt. That can add tens, even hundreds of millions in costs daily.
Which leads perfectly into a final thought for you, our listeners, to chew on. If we accept this higher cost range, and we understand that even a tiny bump in borrowing costs, just 5 basis points, adds over $50 million a day to our national interest bill, what does that really tell us?
It tells us something profound, I think.
Uh-huh.
It highlights the staggering, persistent cost of political uncertainty itself, not just the cost of an actual formal shutdown.
Meaning the risk is always being priced in.
Exactly. It means the cost of brinkmanship, the cost of dysfunction, is potentially baked into the borrowing costs of the world's largest economy every single day. That interest premium, however small it might seem day to day, is a constant fee paid by everyone, signaling that the market is always watching, always pricing the risk of failure, whether or not anyone is actually furloughed at that exact moment.
A powerful and sobering perspective. Thanks for walking us through that.
Glad to do it.
And thank you for joining us for the deep dive. We'll catch you on the next one.